This podcast is intended for investment professionals only.
Hello and welcome to the first of two market talks for the month of September. In this week's episode, we'll be talking about last week's US payroll data. We'll be summing up our current strategy views, and we'll also be looking ahead to the G20 summit in New Delhi. So, in decidedly back to school mode and chalking up the questions is me, Frances Watson, and with feet firmly under the desk, Ben Bennett, who joins us from Hong Kong. Ben, great to chat to you. It's been a while.
It's been a little while. Actually, talking about school, we had a big typhoon on Friday. That was meant to be a lot of schools' first day in Hong Kong, and that was postponed. So it was a false start
Whoa.
here, unfortunately. But I think it was okay, the typhoon, but it wasn't. Like I said, for school children, first day is today on the 4th.
Oh, it's not great, isn't it? We have a problem with concrete here in the UK, but I won't go
Oh
into
yeah.
that just yet. So, look, let's just go to the quite concrete, actually, US payroll data. A bit mixed, though, but strong numbers and moderating wage growth. But the US market seem to like them.
Yeah, so at the minute there's this, well, to be fair, it's been all the way through this year and before that as well, this discussion between soft landing, no landing, potential recession. And remember, you need data that's fading a little bit, but not fading too much that we start to worry about a recession. We sort of got that on Friday. It's so hard to know. Even when you get the numbers, the original numbers, they always get revised in months past. So in fact, Friday's data came out with a payroll of 180 something thousand, which is pretty strong. That's all fine. But they revised down previous months. So previous months where we probably were speaking about this and saying it's all fine, well, they've been revised down. So the
Mm.
data is definitely a little bit weaker. I think the reason why investors liked it is because there is some weakness, and therefore you can see that path to a soft landing. Unemployment rate actually went up from 3.5% to 3.8%. If that keeps on going, then you'd be more worried. But that was mostly due to more people entering the workforce, which is actually a positive. People coming off their sort of COVID, I can't be bothered to go back to work type mentality, and actually come back to the workforce, increasing unemployment a little bit. But that's good for productivity. Ultimately, more people coming back to work. So there's a few things there that look like a soft landing. Cooperating data we've actually had over the last couple of weeks, which also feel a little bit more soft landing-ish. And I think that's why markets received a bit of a boost on the back of that.
So, cooling US labour data then, but in Europe, we've got sticky inflation still and a bit higher than authorities actually want.
Again, there's this balance, isn't it? You want to see inflation data decline globally, and it has been generally. Headline inflation certainly because of lower energy prices compared to the increases that we were seeing this time last year. So that's headline inflation is coming down, but everywhere's a bit sticky. And I do think when you dig into the data, both in the US and particularly in Europe, you mentioned this, we had some just recently. Yeah, the data does look a bit sticky, a bit too high. Central banks, whenever they get the chance, always say, look, the fight is half done, and we're going to have to continue our efforts to keep the pressure on, keep interest rates high. And interest rates are high. I mean, let's say the Fed probably now, I suspect, won't be hiking any more this cycle, but they don't look as though they're going to be cutting anytime soon, do they? In Europe, they might hike another time. I don't know. But again, they're not cutting anytime soon. So we've got interest rates that are high. They want to keep the pressure on inflation. We're starting to see some weakness in the unemployment data. My concern, and it's always been this case, we can talk about markets in a second, but my concern is that the lags that you get with all this tightening monetary policy are so hard to work out that ultimately we will still see that deterioration, potential recession by the end of the year. That's what I've always said on this, isn't it? So I still think that that's in play. And unfortunately, the road to a recession probably looks like a soft landing to start off with. It'll look like we're coming in for landing, and then the recession is when we go through the runway, I suppose. And that's the problem. And we won't know that until a little bit later on. And until that happens, we can hope that there's a soft landing. And I suppose that's how markets have reacted.
No, it's difficult, isn't it? It's got to be finely tuned, and
Yeah.
we just have to wait in the viewing gallery and see all this. Now, a different story, of course, in China, where help is on the way in the form of lower mortgage rates and support for the renminbi.
Yeah, China has been pretty dismal from an economic point of view all year, hasn't it? And we had the Politburo meeting a few weeks ago saying that, we need to do something about this. It's taken a while for those policy wheels to get into motion, but we have seen some concrete efforts in the last couple of weeks, particularly the last week or so, announcing potentially lower mortgage rates for existing mortgages, an ability to get a discount first-time buyer mortgage, where now you don't need to be a first-time buyer, you just don't need to have a property in that vicinity. Some sort of marginal easing. They've also eased things like stamp duty when you buy equities. So yeah, if you look at each one in individual terms, it doesn't look as though it's enough, but they do add up to something more concrete. And also because everyone is so depressed about Chinese economic growth and markets sentiment is so weak, it doesn't actually take very much to have a pop. I mentioned on Friday we had a typhoon here in Hong Kong. Singapore was on holiday as well for the presidential election. So today was the first time we reacted to that, and some news over the weekend of Shanghai and Beijing adopting some of these measures. And it has led to a decent increase in local stock markets. The Hang Seng was up at one point today, 3%. So, that's a decent move, but it's off miserably depressed levels. So let's just wait a little bit and see if this continues. I think there's a little bit more to go before they can sound the problems are over in China in terms of the economy.
Let's just pick that up though, because I think you had your strategy meeting recently, and the
Mm.
point is the view or the consensus view seems to be coming around to the fact that you might have reached peak bearishness in China. As you say, very early
Yeah,
days, but news is so
yeah.
bad it could potentially be good, that one.
That's right. And at times, not at the minute, but at times over the summer, we have had tactically overweight positions on Chinese equities, not because we're particularly bullish from a fundamental point of view, but because, as you say, the bearishness might have met the sort of the lowest level that it could possibly get to. And if everyone's sold out, then it can only go one way, which obviously that's an oversimplification. But when there is the potential for some positive surprise and everyone doesn't think that that's going to happen, that is a time when you can be tactically optimistic. Like I said, not at the minute, but that's probably the way that we're playing it for the medium term, to look at those opportunities when bearishness goes too far.
And another feature of the summer months that I picked up on has been the firmer oil price. What's behind that, Ben?
Yeah, it's an interesting one, because you'd have thought oil price, industrial metals, that type of thing would be improving based on hope, let's say China's recovery and construction. But it's not really, actually, unfortunately. It's more the supply side, not the demand side. So it's concerns or forecasts that oil supply will be kept under lock by OPEC Plus and Russia supply, etc. So I think that's been the increase. But yeah, oil has been, Brent is up above $85 a barrel as we're talking here, which is basically the peak for the entire year. And I mentioned before about energy having moderated its increase compared to last year. And that's a good thing for central banks, because we all see that with the price of petrol at the pumps. That's something that we really attune and think about when we think about inflation. So it's good that that's going, but it's back at the top of the year. So that's going to start impacting people. Natural gas, do you remember the panic last year when we all thought that Europe was going to run out of natural gas? Well, careful for the rest of this year as well, because there's a strike potentially in a big production facility in Australia that does an awful lot of natural gas that could interrupt supply as well. So natural gas prices have gone up again recently, even in Europe, which is obviously quite a long way away from Australia. But the global side of this is pushing prices up, even in Europe. Nowhere near where we had this time last year. But again, these things are just taking away some of that positivity from the headline inflation that I was talking about earlier.
And of course, majority of commodities priced in dollars.
Hmm.
Just remind us, just quickly, Ben, where we are on the Dixie.
Yeah, the dollar's been strong again over the last few weeks, and it's more that the US hasn't been as weak as Europe and as weak as China. That's sort of the story here. So the US growth is maybe, we spoke about the job market moderating, but it's still the economy. GDP for Q2 was fine, two and a bit percent. Q3 is running potentially even better than that. European data has been a bit weaker. We spoke about inflation being too high. Also, the actual activity data hasn't been good. I think that Germany, for example, could be weighed down by some of the weakness that we're seeing in China. China's been weaker. So you add all that up, And you say probably then the Federal Reserve, on balance, relatively, would keep interest rates higher than, say, the ECB and obviously the PBOC in China. So if you're looking to hide your money and achieve some decent yields, people have been choosing the US because that's where you're getting better growth. That's where you're getting better interest rates. So if you're moving money to the US, of course, that's good for the dollar. And that has been the case. Now, from a global perspective, people who borrow money, so companies, governments, and people who borrow dollars, so lots of international companies, international governments, emerging markets, the stronger the dollar is, the worse it is for them because they've got to repay something stronger. So all of this, the dollar strength is a little bit of a negative that we have seen recently. We've had relatively high yields in the US for the reasons I just mentioned. A strong dollar, that's actually been squeezing a little bit equity markets globally. August equity markets were down a little bit over the course of the month. So I think that combination has been a little bit of an issue in terms of credit conditions.
So tightening continuing, basically.
Yeah.
So let's just quickly skirt over a bit of a quiet week, actually, I guess, because it's Labor Day in the US today as we record on Monday. But we have got some beige book data from the US, and we've got a raft of global service sector PMIs telling us, I guess, on the state of the economy. What are the key signs to look out for there, then, Ben?
Sentiment indicators have been weaker than actual real data. We had, the European PMIs have been weak. We'll see what the service sector ones are looking like. Again, there's this fine balance between a soft landing and a recession. My concern is that Europe is tipping into that recession territory, large parts of it anyway. So let's see what the service sector PMIs look like. Beige book is a really, really, really useful anecdotal summary of conditions in the US, economic conditions in the US. I mentioned that GDP is running sort of 2-3% annualized pace in the US, which is fine. And we'll see if that is corroborated from a sort of bottom-up perspective in the US. So that's what I'm looking out for. The US remaining relatively okay, keeping upward pressure on yields, keeping the strength in the dollar. Everywhere else in the world is looking that it's fading a little bit. European growth is a little bit weaker, and that again would probably keep upward pressure on the dollar. It would make me a little bit nervous about markets going forward, equity and credit markets, if that continues to be the case.
Okay, interesting. Now, towards the end of the week, we've got the G20 summit in New Delhi. I have to say, there has been quite a lot of press coverage on this one, Ben. We've been told that primate cutouts are being used to deter marauding monkeys from munching on the floral displays. But I'm sure you have a different takeaway to the one
Actually, I missed that. I must be reading the different newspapers, Chief Francis. But I was more taken by the fact that it sounds as though President Xi Jinping from China is not going to go, and of course, President Putin is not going to go either. So otherwise, he could be arrested. So it's an interesting one on the G20. It's as a group, it does feel as though as I said, the Russia's sort of persona non grata at the minute, and China potentially. If I'm trying to be optimistic about this, I'd say China is focusing more on the bilateral political discussions that are happening between, say, the Commerce Secretary in the US visiting Beijing the other day, Anthony Blinken visiting Beijing, and Janet Yellen, all these sort of bilateral moves. And they want to build up in a relatively progressive way through to probably the end of this year, when Xi Jinping will meet Joe Biden, and maybe the G20 is just too soon to do that. Or maybe his diary is too full. I don't know, but that would maybe G20 is a little bit too soon for that. But I'm still hopeful that relationship is thawing and improving from that perspective. So I won't worry too much, but maybe it undermines the G20 to some degree because. Yeah, it's not everyone's there, I guess, is the best way
because one of the key players isn't at the table.
Yeah.
Let's turn then finally, Ben, to your number of the let's say it's number of the week, because we've got 2 market talks this month. What is it and why?
So I've spoken about high yield a little while. I do sort of use the high yield market as a good barometer of credit conditions, and we've been talking about credit conditions and high yields and the stronger dollar. So I was looking at the high yield corporate bond index. So this is weaker companies, what they have to pay to fund. and I was using 8. So my number, I guess my number of the 2 weeks, the fortnight is 8. And I was looking at the index, and how long has it been above 8% for recently? It's basically been above 8%, that yield, that index, since February this year. So whatever, 200 odd days. So these companies have had to, on average, pay over 8% for when they want to do a bond, which is quite a lot. If
That
you go
is
back,
juicy, isn't it? Yeah.
because if you go back, for example, since, do you remember the shale gas situation back in 2016? That blew up a lot of high yields. So, but post that 2016, all the way up to basically the day before COVID became a real thing, that was basically 4 years. And there was only 4 days during that 4 years where the yield was above 8%. So you sort of have companies that funded over that period of time, that 4-year period, were always funding below 8% and perfectly happy. And now, fast forward to today, and the same companies are being asked to fund at 8% or above, and they have been doing for a while. I think a lot of companies have been sitting there hoping that yields come down, because ultimately that costs them an awful lot of money and it could put them into difficulties, hoping that it'll come down, but it hasn't come down yet. And if inflation doesn't come down, if Fed can't cut interest rates, they're going to have to continue with it. This is almost the no landing scenario, and it's why the no landing scenario can't really work, because ultimately these companies will suffer from that 8% yield over the course of time. You're going to start to see more get into trouble.
So in your view, default rates will have to rise if yields are that high?
Yeah, I mean, I think default rates do rise. It depends if we get a recession as to how much. I mean, they only rise a lot if you get a recession. But like I said, that's a real risk for me, and the fact that these companies are having to pay more and more interest rates increases that chance for me.
Well, on that slightly more sobering note, Ben, thank you. It's great to talk to you after the summer months, and thank you very much for coming back, talking to us again. Of course, you'll be talking to us regularly for the months ahead. Ben, great to talk to you as always, and thank you all for listening. Thank you. As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. This podcast should not be taken as an invitation to deal in legal and general investments. Any views expressed during this recording belong to the individuals and are based on market conditions at the time of the recording and do not reflect the views of legal and general investment management. Forward-looking statements are, by their nature, subject to significant risks and uncertainties and are based on internal forecasts and assumptions and should not be relied upon. Where individual stocks are mentioned, these do not constitute a recommendation to buy or sell any security and are for illustrative purposes only. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. For full terms and conditions, please visit our website. To find more content, you can check us out on Twitter, LinkedIn, and our website. Copyright 2023. Legal and General Investment Management Limited. All rights reserved. No part of this publication may be reproduced or transmitted in any form or by any means, including photocopying and recording, without the written permission of the publishers. This material is issued by Legal and General Investment Management Asia Limited, the Licence Corporation BBB 488, regulated by the Hong Kong Securities and Futures Commission, for professional investors only.